Well, let's get more on the direction of rates and banks. Bring in Mark Newton of Newton Advisors. He's over at the Plasma here to give us the charts. Mark.
Thanks, Melissa. Hi. Increasingly, you're starting to see more and more strength out of the banks, despite the fact that yields have actually gone lower for the last 10 months. So you take a look at the main bank ETF, the KBE. It's showing you a couple of different things. Prices have been largely range-bound over the last 5 months. However, they're starting to show increasing signs of strength just in the last few weeks, and we're testing these prior highs. Getting over that prior high would allow us to make a move right back up towards, the prior peaks that we saw. So that's really the one thing to put into example. Financial ETF, the XLF, this is something has shown a very decent longer-term base just going back since that prior peak. And so despite the fact that yields have been falling, you've seen a decent amount of strength to move right up to test this prior level in XLF. So my thinking is, it's likely that we're going to start to see increasing signs of financials starting to rally despite the fact that yields are falling. Finally, this is what puts it all into perspective, is the fact that on a relative basis, financials have actually been strengthening despite the fact that yields have been falling. This is a relative chart of XLF versus the S&P. You see that we're starting to make higher and higher lows. Even though we're still in a downtrend from last February, this is a time when yields largely started to peak out and started to fall. Of course, we peaked on or around last November and have been falling ever since in yield. But now you're starting to strengthen at a time when yields are still very much in a downtrend. We rallied about 10 basis points today in yields in the 10-year. And, of course, the yield curve has popped to about 5 basis points. But in general, this is a sector to really pay attention to. It's not going to take much more. You've already seen stocks like JPM hit new all-time highs, Citigroup and Bank of America well-positioned. And Pete was talking about upside call buying and things like Citigroup. And so I think the sector is really starting to look a lot more interesting at a time when, everybody's been talking for years about, okay, the financials are in good shape structurally. But now finally you're starting to see technically at least a few signs of this group finally starting to work.
Mark, I'm curious because if you take a look at that chart, for instance, that September lowest low coincides with where we saw the lows for yields effectively, right? And so financials have really been dependent on where spreads go and where yields go. So when you take a look at the chart of spreads or the chart of the 10-year yield, for instance, does it follow typical technical patterns? I mean, can you actually analyze it technically with as much accuracy as another chart when so many people are saying that there are so many other external factors, dictating the direction of yields?
I think you're right. I mean, I think the yield curve is probably a little bit better, something to concentrate on versus just a 10-year itself. Because as I noted, yields have been actually falling since last November, and yet we've seen actually a decent amount of strength in the XLF. And of course, a lot of that's Berkshire, Wells Fargo, Citi, Bank of America, the big boys. But yet, the sector has managed to strengthen on an absolute basis and looks in far better shape than it should, given the fact that yields have just been really falling pretty dramatically. So my thinking is, yields likely are going to bottom around 2016 or even 2012 lows, and that's right around 131 to 136 or so. And it's tough to make too much of this bounce today. 163 to 173 now, but I think that in general it should be a level that yields start to stabilize. And if that's the case, then the U.S. is still growing faster than a lot of the world, and if yields start to turn higher, then that should be a decent sign for the XLF and with regards to the yield curve as well.
All right, Mark, thank you. Mark Newton of Newton Advisors. We had a bunch of bank bulls comment to the right of me. So, Dan, I'll ask you what you think.
Well, I would just say there's only one bank right now. It's J.P. Morgan. The investment banks are down 25% from their 2018 highs. That's Morgan Stanley. That's Goldman Sachs. You have Bank of America and you have Citi, each down about 12% from their highs. I see what he's saying in relative strength. I want to make one point, what you made, Karen, earlier in the show. When Trump's back is up against the wall, he goes back to his greatest hits. One of his greatest hits is calling for lower rates. And as Trump gets in more trouble, if this situation mushrooms a little bit, that means Senator Warren rises in the polls. A double negative for rates, a double negative for banks. Like what I'm saying is, I don't really see it as a great setup. If you want to own a bank, own J.P. Morgan because they got your guy.
Go lower under Warren? I think they'll go higher.
Banks under Warren?
I think not the banks. Rates.
From here until there, rates go lower because Trump's going to keep hitting him. From here, as Warren rises, banks go lower because Warren's going to keep hitting him.
because of the fear of regulatory
I
pressures.
think I get that. I know obviously the yield curve is really important to banks, but I think what's been happening is as the rotation out of momentum towards value, this sector is really a value play, even having moved a lot.
Right.
JP Morgan still at 11, 12 times earnings. That's not crazy.